Namaste traders. Are you new to USDINR futures? Today we're diving deep into a complete educational guide. We'll cover why it moves, how to spot 3 key patterns, and the simple math behind managing your currency risk. Let's get started. Lesson 1. The 4 main drivers of USDINR. First, the US Fed rate. When the US Federal Reserve raises interest rates, the dollar gets stronger, pushing USDINR higher. Second is RBI intervention. The Reserve Bank of India often steps in to sell dollars when the price gets too high, like above the 85-80 level, to stabilize the rupee. Third, oil prices. When crude oil goes above $80 a barrel, India's import bill increases, which weakens the rupee and sends USDINR up. And fourth, FII flow. When foreign institutional investors sell their Indian investments and take their money out, it puts pressure on the rupee. So, a quick tip for your Monday morning. Always check the US economic data released on Sunday night and the current price of crude oil. Now for Lesson 2. 3 highly reliable USDINR patterns. These have about an 80% reliability rate in my experience. First is what I call the RBI magnet. When the price tests that 85.80 level multiple times and fails to break it, you can often expect a strong bounce downwards. Second, the range break. USDINR often trades in a range, for example, between 85.20 and 85.80. A breakout from this range, either up or down, usually leads to a significant move of at least 50 Ps. Third is the EMA bounce. Look for the price to test the 20-period exponential moving average on the chart. If this test is accompanied by a spike in volume, it's often a strong signal for a reversal. A great weekend exercise is to go on TradingView and look at historical charts to spot these patterns for yourself. Finally, Lesson 3. Proper position sizing for currency trading. This is crucial. Let's say you have a trading capital of 75,000 rupees. If you follow the rule of risking only 1% per trade, your maximum risk is 750 rupees. Now, let's say your stop loss for a USDINR trade is 20 Ps. In futures, that's a loss of 1,000 rupees per lot. So, how many lots can you safely trade? You take your risk amount, which is 750, and divide it by the loss per lot, which is 1,000. That means you can only trade a maximum of 1 lot. The pro formula is simple. Your risk amount divided by your stop loss in points equals your safe quantity. Here's an educational framework for Monday. What if the price tests the RBI level of 85.80, bounces off the 20 EMA, and shows high volume? Then potential trade idea could be